I want to start with section E of the syllabus. Right. Section E of the syllabus is on business finance. And I always like to start with a reminder of how various sections of the syllabus are linked. And this is a popular formula that says that in business finance, assets can be purchased either by using equity, debt or equity. Right. So these are the two sources of finance. These are the two sources of funding any asset. Is that you use a third party's money or use own money. Equity is your money. Okay. But remember, we said this asset is divided into both current asset and non-current asset. The same way we have liability divided into non-current liability and current liability. What we dealt with under section C of working capital is current asset and current liability. This part, this is our working capital and we've dealt with it. So now we want to look at non-current liability and equity. Remember, under business finance, our focus is on long-term financing. Long-term financing. The short-term financing is current liability, which, like I said, we looked at under working capital. So the starting point for us is to know that sources of capital will always be either from debt, which is someone else's money, or equity. These are the two major sources of capital. There is no form of capital that is outside of these two. In fact, sometimes we have a special instrument that usually behaves as both items. It sometimes behaves as debt and also has equity characteristics, and that is called the preference shares. And that's why it's always in the middle of debt and equity. So preference shares. Yeah, preference shares has both characteristics of debt and equity, but is not any different from any of those two. Okay, now we need to look at each of these one after the other. Remember, you are a finance manager, and as a finance manager, you are expected to make 3 decisions: investing decision, dividend policy decision, and financing decision. What we are looking at under this section of the syllabus is your ability to make financing decision, which means you must be able to tell a company whether they should finance the purchase of an asset or investment by using debt or by using equity. And you need to understand how all of these types of capital operate. The cost, which is very important because you want to minimize cost of fund as much as possible, restrictions, and all other forms of accessibility. So you need to have a broad understanding, and I'm going to start with equity. So we're looking at equity today in this recording. We're looking at equity. How do we get funding from equity? But before then, what is the meaning? Because you need to know what it is. So equity is funds made available to business by the shareholders with right of ownership. So when you give funds to a business, and by giving that fund, that money to that business, you are able to acquire right of ownership, then that kind of fund is an equity. Is an equity type of fund. That is the meaning of equity. And what are the advantages and disadvantages? You need to know that as well. And that will be coming from the characteristics of equity. So based on the characteristics, which you will see 4 of them still, both advantages and disadvantages are characteristics of equity, because it's because you have those characteristics that you're having those advantages and disadvantages. So I'm going to use that to summarize it. So what are the advantages? The first one is the fact that the company is not obliged to pay dividend. So there is no compulsion. So not obliged. So there is no obligation to pay dividend. So you can actually be collecting money from shareholders and not pay dividend, and you don't have problem. Yeah, no legal problem, except shareholders decide to sell because you are not paying dividend. Maybe not the best not to pay dividend, but at least there is no compulsion that you must pay dividend. The same way, the principal amount, which is the fund the shareholders have made available, don't have to be repaid back to the equity holders. You can buy share in a company today and that shares come to zero, or if the company liquidates, you might not get your money back. You cannot sue the company as a shareholder, right? So likewise, no obligation. So all this makes the life of the company easy. No obligation to repay shareholders. Yeah, we're talking about their investment here. So which is different in debt, which we'll see when we get there. This is like a principal in debt, principal amount, and in debt, this is what you call like interest. Yeah, this is dividend return. This is like interest, which both are mandatory under debt, but for equity they are not mandatory. There is no obligation to repay them back, right? Likewise, equity has higher return than debt. And you can guess why. Remember, we said the higher the risk, the higher the reward. Because equity is riskier than debt, definitely whoever is taking that risk will be requesting for more return. So because of that, equity will generally give you more return than debt. And good, there are advantages, but likewise, there will be disadvantages. The first one is that it's expensive to raise. Because when you are trying to raise equity, there are all sorts of costs involved. You need to get consultant, you need to get legal practitioner, you need to pay issuing house. So to raise equity fund can be quite expensive. Likewise, for equity holders, when they even get the dividends, they still get taxed on it. So dividends are not tax deductible. Unlike debt, that is interest is tax deductible. For equity, the dividend is not tax deductible. Instead, you still pay tax on the dividend. And likewise, even for the company that is paying the dividend, it's paid profit after tax. So you don't get to benefit from that deduction before you arrive at profit after tax. So that is another reason why this is a disadvantage, right? And when you look at this two scenario, yeah, and with the last one, it is riskier for investor. Yeah, so riskier, and as such more costly. So without saying too much, these disadvantages that I've summarized below is actually the reason why equity has higher cost of capital. Because this is a typical exam question. I might just ask you, why is equity considered to be more expensive for company than debt? Just tell them, because number one, the dividend is not tax deductible and it is riskier and is more expensive to raise. All of these contribute to the reason why debt is generally considered to be cheaper. So therefore, please note, in finance, debt is generally, you need to know this, cheaper than equity. Not to say that there won't be instances when equity can be cheaper. However, generally speaking, debt is considered to be cheaper. Please take note of that Very important to know. So now you know the meaning, you know the advantages and disadvantages. How do we raise equity? You need to know the basic concept of raising equity, which means how do we get this money from shareholders? How do we raise equity from shareholders? Now, it depends on the type of company. And in this regards, there are generally two types of company. We have the private company, which is usually not listed on stock exchange. That's why they are called private company. An example might be like SMEs. And we have public company, which are usually listed. Another way is to say they are quoted on stock exchange. So this one will be unquoted. Right. So you have listed, or what you call quoted, or what you call public company. Same name. Yeah, so please get used to that. Now let's look at the private entity first. How do they raise equity funding? Generally speaking, you need to know that it is very difficult for these guys to raise equity funding because they are private company. The information is not readily available. They are not readily marketable as well. And because of that, equity financing is very difficult for them. Remember, equity financing is about you going to the market and telling the market that you have shares of your company to sell, and willing investors will come to buy those shares and give you their money. But if you are not listed, which means you are a private company, it's very difficult to do that. And that is why you now need to know what are the alternatives, because equity financing is not always available. What are the alternatives of funding for SMEs? Very important to know, and I'm going to go through them quickly. The first one is that they can use their working capital, which is a typical example. Is either they are trying to negotiate long payment terms with their vendors, so that is account payable will go up, or they are getting overdraft from the bank. That is one way they get funding, because they are not really able to get funding from their equity holders. They can as well get from existing shareholders, but not all the time this fund is always available for them. They can ask existing shareholders to bring more money, but not likely they get the kind of funds that they need. Likewise, they can also use their retained earnings, so which means out of all the profit they've been making in so many years, they might decide to use some of the profit that have not been shared as dividend to their shareholders, and that is retained earnings. Please, you need to know all these forms. Likewise, they can just go to the bank and plead to the bank to give them loan. So bank loan can be there for them. This is a debt, right? And other alternative would be business angels, and venture capital. Remember, these are typical investors, and what they do is they look for companies that have high potential, which means have possibility of doing very well, but currently the company is struggling to perform, either because of poor cash or poor management. So these venture capitalists or business angels, they will come in with their money, buy off the company, they turn it around, and after they turn it around, they sell to other investors. That's how they cash out. So those are the alternatives that are available to SMEs. Like I said, it's a typical exam question which you need to know. Now let's go to the proper equity. The guys that are able to raise equity, and those are the public companies. How do public companies, how do they raise equity? For a company that used to be private, that want to become public so that it is able to raise shares, the way to go about it is called initial public offering. That means that is the first time this particular company, IPO, is called IPO, initial public offering. The first time this private company is going to make itself public, right? And if you're able to do that, then that kind of equity fundraising is called the IPO, which is initial public offering. Yeah, if you have done initial public offering before and you still need more money, then it is called public offering. In that case, you are being a public listed entity, but you just need more money and you are looking for more investors that will be happy to invest in your company. Right. And all of this requires a lot of work, documentations and everything. That's when you spend money on issuing house, on consultant brochure, because you need to prepare a document that shows what you want to use the money for, how much shares do you need, how much fund do you need, how will you account for those money, so that investors that are looking forward to investing, they can really be interested and feel comfortable to give their money to you, right? Okay, so, and as a public company, it comes with a lot of responsibility. You need to prepare accounts. You need to make your financial statement available to the public. You need to be audited by top companies, all of that. And that is why it comes with a cost as well. And if you don't have that money, you want to stay private. Yeah, but likewise, you also lose out being able to get funding from the public, right? So that's public offering. Another way they can go about it, looking for money, is called placement. Placement is also selling shares. However, you are selling to selected people. So you are not going to the public fully, like public offering. This one, you are selling to selected institutional investors. Right? So probably you just identify big institutional investors and you are speaking to them to say, please guys, I need you to invest in my company. These are our prospects and all of that, right? So, but you are still a public listed entity. So you're only targeting few people because you don't want to sell to the public. Maybe you don't want to dilute your ownership too much. You don't want so many people to become owners. You just need few more people, right? That's placement. Another way you can raise fund is through right issue. And for right issue, you are raising fund from existing shareholders. Similar to what SME can do when we spoke about it here, that they can also get money from existing shareholders. Yeah. So likewise, a listed entity can do the same thing. And here, the reason why they would do it is they want to avoid dilution. Avoid dilution of ownership. So if you have 100 shares before and 4 people, maybe just even 3 people, you have investor A, B, C that has 20 shares, this one has 40 shares, and this one has 40 shares as well. So which means this guy will have 20%, this guy will have 40%, and this guy will also have 40%. If you decide to issue another 200 shares so that your shares become 300, you're going to allocate these 200 shares based on their existing ownership. So which means for this guy, you give him another 40 shares. This one, you give him another, that is 40% of 200, that is 80. And this one will get another 80 shares. So eventually, A will now have 60, B will have 120, and C will have 120. So that the total number of shares in issue is still 300, and the percentage ownership will still remain 20%, 40%, and 40%, because 60 over 300 is 20%, 120 on 300 is 40%. Right. So that is what right issue is all about. That is how they raise money using the right issue. But I'd like to speak a bit more on that right issue so that you have a full understanding. So let's talk about right issue a bit more, so you understand how it is done. Usually, right issue involves you selling share to existing shareholders at discounted price, discounted market price. So if the price of the share in the market is, say, let's say market price is currently at $5, if you want to do right issue, you need to make it attractive to the existing shareholders. So right price will probably be at a discount, maybe at $4. And usually they will also tell you the ratio. So you need to also know about the ratio of issuing. Usually, because they also always want to make sure that there is no dilution, there's going to be ratio. Yeah. Imagine for the example I gave here now, you want to issue 200 over the 100 that you have. So that means you are issuing 200 with ratio 100. So that means you are issuing 2 new shares for every 1 existing share. Yeah. But sometimes it can be lower number of shares for more higher number of existing shares. It can be any ratio. But whatever ratio you are giving exams, you need to know how to work with it. So take for instance, if current number of shares is 1 million and right issue ratio is, say, 1:5, that means 1 new share for every 5 old shares. Yeah. In that case, how do you know the total number of shares that will be issued? Just do the same extrapolation. If you are issuing 1 for every 5 old, and you know you have 1 million old, then the new number of shares will be 1 million times 1 divided by 5. And if you do that, that will give you 200,000 shares. That means, 200,000, yes, 200,000 shares. So that means you are issuing new shares to that figure. That is how you know the number of shares that is being issued. Now, the next concept that I'm going to touch on here is the concept of theoretical extract price, which is very popular in exam. Theoretical extract price. And I'll just give you a quick way to calculate your theoretical extract price, and likewise theoretical right value. Very important that you also know how to do that. Okay, so let's just use an example to do it, and it's not more than that. It's always as easy as that. So let's say company A has issued rights at 1:4. Current share price, let's say $5, and the right price, which is the price is going to sell the new shares, or that has sold the new shares. So the right price is 20% discount. Sometimes they will give you the right price, sometimes they give you as a discount. So which means you need to calculate the right price. Right. Now say calculate theoretical extract price. I mean, this is very simple concept, but some textbooks have made it so complicated that students struggle sometimes. Right. So first of all, you need to know your right price. If the right price is 20% of discount, 20% discount of market, and that means you're only paying 80% of market price. Yeah, and that is 0.8 times 5, which is $4. That's one way of doing it, of getting your right price. Another way of getting your right price is to say, okay, discount, how much is discount then? The 20% discount is equals to 20% times 5, and that is equals to $1. Then the right price will be equals to market price minus discount, and this is equals to $4. So this is method 2 and this is method 1 of getting your right price if you have a discount. But sometimes or most times the right price should be given to you straight away in the example. You should also still need to know how to work it out like this. Now remember, we want to calculate the theoretical extra price. So you start with the right ratio. That's how to start from, the right ratio. You must know that. Sometimes they say the company has 1 million shares and is trying to issue another 400,000 shares. You know your right ratio, you need to get it from that. That's 400,000 ratio 1 million. So that means for every 10, you're going to issue 4. And that's like the same thing as 2 ratio 5. Right? You just need to know how to work it out. Right. So for right ratio, we are given direct is here. Most times you will always be given. So that's 1 for 4, 1 ratio 4. Then you need to ask yourself, what is, so this is the ratio. Then put the price. Then put the value. The new right issue will be sold at $4. So price is 4. And the old one is at market price of $5. So value is price times quantity. So 4 times 1 is 4. 5 times 4 is 20. So which means the total value is 24. That's 4 plus 20. And the total quantity is 1 plus 4. That is 5. So your theoretical extra price is equals to 24 over 5. And that will give you 24 divided by 5. And that will give you $4.8. So that's your theoretical extra price. So, and how do you interpret it theoretically? What we're saying is that though we are not able to say specifically how much the price of our share will be after we have issued the right, but this is an indication of where it might trade. That is the importance of theoretical extra price. You're able to tell the likely region where your share price will be after right, because generally when a company issues right, the price of that shares generally drops after the issue. Yeah, because the company is already selling its own shares less than the market price. So generally, you expect the price of the shares to drop. But where it's going to drop to, you don't know. So this just gives an indication. And in terms of value of right, you also need to know how to do that. Value of right. And it's the same thing as like a profit. Like if you have bought something, how do you know whether you have made money immediately? You only have made money immediately if you have bought that item less than its current price. And remember, the current price is not the market price again, but rather the price the share will be when it is in your hands. Before it got to your end, it was trading at $5. So this is not your value. This, you don't have business with this. You start making sense to you when you have bought it, and at that point you expect it to be at 4.8. So your value after right, that value of your right will now be equals to 4.8 minus how much did you pay for it? We paid $4 for it. That's your right price. You pay for that, and that is equals to 0.8. So this is your right value. So that one right share that you got gave you this value. For every one new share that you got, that is a 0.8. But sometimes, so let me write it well for you. So the right value of the new right issue, yeah, this is per share now, is equals to 0.8. Sometimes the question can now be twisted and say, what is the value for every old share? So for every old share, remember, you got this value because you add how many shares? You add 4 shares. In that case, for every old share, which means per old share, for one old share, it will be equals to 0.8 divided by 4, and that will be 0.2. So depending on how the question has been configured or stated to you, know that the first thing you need to know is the right value of the new right share, which is usually the theoretical extra price minus the price you paid. However, for every old share, you need to divide that value by the number of old shares that gave you that theoretical extra value.